Alright, hello again. Onward to part 2 of the Chapter 3 presentation, starting on slide number 21 in the pack. And now we get into what an account is. We've been talking about them a lot already, but we're going to get into more of a definition here. And an account is what we've observed in the last few minutes with the various transactions and their effect on the accounting equation. For instance, cash and supplies are asset accounts that normally have debit balances, as I've been showing you with the little whiteboard and the T accounts. Accounts payable and common stock are liability and stockholders' equity accounts respectively, and each has a normal credit or right side balance. The slide uses an illustration of a T account, which may be helpful in your understanding of debits and credits and when they increase or decrease the various asset, liability, and equity accounts. On slide 22, as we've seen in the previous slides, there have been 2 entries for every transaction, and each entry has some impact on the basic accounting equation. Each transaction causes at least one account to be debited and at least one account to be credited. Note, it depends on the nature of the transaction as to whether the debit will increase or decrease the account, and the same with credits. For example, a cash payment on account to a supplier will debit accounts payable, decreasing a liability that has a normal credit balance, and credit cash, decreasing an asset that has a normal debit balance. If you can follow this logic, it's key to your understanding the rest of the chapter, and indeed the rest of the course. Remember that debits must always equal credits for each transaction because this is how the accounting equation stays in balance. The example here should hold true for an asset account or an expense account, since expenses decrease retained earnings on the right side of the equation. So if debits are greater than credits, the account will have a debit balance. Moving to slide 24, this example should apply to liability and revenue accounts that normally have credit balances, since revenue increases retained earnings on the right side of the equation. And this slide sums up what we've just been talking about. Remember, tattoo this on the inside of your eyelids if you must, that assets have normal debit balances and liabilities have normal credit balances. So the normal balance, as it says, is on the increase side. Now let's look at how debits and credits work for the stockholders' equity accounts as shown in this slide. First, look at the things that increase stockholders' equity and why. Owners' investments, infusions of cash, and revenues, that is, increases in retained earnings. Next, we look at the things that decrease stockholders' equity, dividends and expenses. Dividends are cash payments to shareholders that decrease assets and retained earnings. Expenses reduce retained earnings because they have a negative impact on the bottom line, or net income. Therefore, these accounts that have normal debit balances reduce stockholders' equity because stockholders' equity has an overall normal credit balance. On slide 27, as we've alluded to in the last few slides, revenues increase retained earnings and therefore stockholders' equity. As stated, the purpose of earning revenues is to benefit the shareholders, and that is what enables the company to pay dividends. And therefore, the effect of debits and credits on revenue accounts is identical to the effect on stockholders' equity. Whereas for expenses, the effect is the opposite. Increases to expenses decrease retained earnings overall and thus stockholders' equity. Slide 28, again, here's a refresher on how the balance sheet, income statement, and retained earnings statement are interrelated, especially when it comes to the stockholders' equity section. Net income from the income statement is transferred to the retained earnings statement as an increase to retained earnings, and the ending retained earnings balance is shown on the balance sheet, as shown here on the slide. Slide 29, this slide summarizes what we've been talking about. Again, this is knowledge you need to ingrain in order to perform well on the homework assignments, quizzes, and exams. I know that intuitively this model does not always make sense to some of you. For instance, why does an expense have a debit balance when it seems to be akin to a liability that has a credit balance? Both are bad in that they reduce the company's financial position and income, right? But you need to think of expenses as a decrease to retained earnings, which is on the right side of the accounting equation and has a credit balance. Therefore, expenses that decrease retained earnings will have the opposite type balance, or debit. On slide 30, here's yet another way to look at it. This shows how the debits and credits work for each type of account: asset, liability, equity, revenue, and expense, to either increase or decrease the balance depending on the type of account. For instance, increases to cash, an asset account, are debits. Decreases are credits. For those of you who work or have worked in banks, this may not seem to make sense, I realize. But in the accounting world, that's the way it is. Slide 31, this chart summarizes what we've been going through with the series of sample transactions and their effect on the basic accounting equation. When we expand the basic equation, as has been done here, it's easier to see how various transactions affect either one or both sides of it and keep it in balance. Review question here on slide 32. Hopefully you can see right away why A and B are wrong. Debits increase assets but decrease liabilities, since liabilities have normal credit balances. Answer D is the direct opposite of the correct answer for this reason. So C is correct because debits increase assets and decrease liabilities that have normal credit balances. Slide 33, review question. Again, hopefully you can see why D is the correct answer here and the others are not. Revenues, liabilities, and equity accounts have normal credit balances. Slide 34, as stated on page 158 of the text, since the type of business, that is sports, is similar, you'd expect to see many of the same type of revenue and expense accounts as shown above for both of the teams. Slide 35, as we move into the recording process, and as it says, a source document, as its name applies, is the source for recording an accounting transaction. So it's very important to keep these documents as support for some predetermined length of time that is determined normally by company management. This is the starting point for recording a transaction. And it gives examples on this slide such as a sales slip, a check, a bill, or a cash register tape. The journal is the book of original entry. In today's world, there's some blurring of the journal's role as we move into accounting, automated systems such as SAP. So journals may not always be labeled as such, but the fact is that there does need to be an original entry point for each transaction, which gives the debit and credit side of that transaction entry. So the complete effects of the transaction can be viewed in that place and in chronological sequence. And that way, if there's more than one transaction that relates to the same thing, such as a couple of different payments on account for the same item, those can be located in a journal type setting without a lot of trouble. So the act of journalizing is recording each accounting transaction individually into the journal. And in doing that, we have to have, obviously, this economic event called a transaction. And the illustration here is coming from the same transactions that we looked at before. The company issued common stock. On October 1st, they borrowed $5,000, signing a note. They purchased some office equipment for $5,000 in cash. We've been through these transactions before as far as their impact on the accounting equation. And as we move to slide 38, using what we've learned about how this transaction affects the accounts and the accounting equation, we can see that we need to debit cash for the $10,000 increase caused by receiving cash for stock. We also need to credit common stock for the $10,000 to show the increase in this equity account. So the journal entry recognizes both the debit and the credit side of the entry and the accounts that were affected and the date that it occurred. And for the next example, where the company borrowed $5,000 on a note, they increased cash or debited it by $5,000. They increased notes payable, a liability account, by crediting it for $5,000. And again, you can still see up above there the impact on the accounting equation that we saw before and the date of the transaction. Moving to slide 40. The equipment purchase is recorded as shown here, with a debit to the asset account equipment, credit to the asset account cash. So both effects of this transaction are on the asset side, and they in essence cancel each other out as far as the overall balance of assets. So therefore the accounting equation remains in balance. And if you go through this example that's in the text, you can see how product cost decisions can be made and the usefulness of accounting information in making these decisions. Those of you who go on to ACC 2415, the managerial accounting course at Northwood, will hear a lot more about this. Slide 42. Here's a pictorial showing what a general ledger contains. That is the entire group of accounts that's maintained in a company. So the general ledger is the next step along the recording process. And we'll see why in just a second here. The chart of accounts is simply a listing of accounts that's used by the company to record transactions. This may be a lot more detailed than what is shown above, depending on how many sub-accounts are needed for more specialized transactions, depending on the company. Note how the journal entry is posted to the GL. First, the general ledger cash account is debited for the $10,000 shown in the original entry. This is the issuance of the common stock entry. So you can see that in the general ledger case, we have the cash account, and so we're going to be showing everything that happens to the cash account during that period. So the GL will show all of the activity for each account separately. So on this review question, answer D is correct because the journalized transactions need to be posted so that their effect on individual accounts can be seen in one place. And with that, this portion of the presentation concludes.